Friends, this is CA MK Kar and I have come to you with a new thing, that is your trading on equity. Let us discuss in detail what is the use of the word trading on equity. Exactly, this trading on equity means use of fixed cost source. Fixed cost source like debt means maybe preference share, maybe debenture, maybe your term loan. Use of fixed cost source to increase earnings and value of the firm. How the fixed cost source like debenture, like term loan, like debt, the company can use, the organization can use to increase the earnings per share of the firm. If the earnings per share increase, obviously the market value of the share will increase, and consequently the value of the firm will increase. So let us see how it happens. So fixed cost source means those capital which carries fixed rate of return. All of we know that is equity share does not carry a fixed rate of return. But in case of debenture, it carries fixed rate of interest. In case of preference share, it carries fixed rate of dividend. In case of term loan, long-term loan, it carries a fixed rate of return, fixed rate of interest. So, if a firm can use the loan to magnify the earning, to increase the earning, then it is good to take a loan and increase the value of the business. Let us come out with an example. Let us see a firm A and a firm B. Firm A has equity capital 100 lakhs. Rupees 10 is share. That means firm A has 100 lakh divided by 10, that is your 10 lakh equity share. So firm A has 100 lakh equity capital, that is equal to 10 lakh equity share of 10 each. Firm B has 60 lakh equity capital. If you divide 60 lakh by 10, that means it has a 6 lakh of equity share. And 10% debenture. Firm B has a debenture of 40 lakhs. Firm A is unlevered firm, no debt. Firm B is a levered firm. And both has a capital. Capital employed, in case of A, it is 100 lakh. In case of B, it is also 100 lakhs. If we take the internal rate of return, that is your rate of return on investment, how much is the investment? Investment in case of A is 100 lakh. In case of B, it is also 100 lakhs. And the company is earning return on equity in case of both the firms are equal, 15%. So, on 100 lakhs, 15% will give you the 15 lakhs, here also 15 lakhs. So, earnings before interest and tax is 15 lakh, here also 15 lakh, right? Now interest. In case of interest, firm A has no debt. There is no debt for the firm A. Therefore, there is no interest here, no interest. In case of firm B, there was 40 lakhs of loan carrying 10% interest. The loan rate of interest of loan is 10%. So 40 lakhs into 10% interest is 4 lakhs. So after deducting the interest, earnings before tax is 15 lakh, here it is 11 lakh. This is your earnings before tax. Now let us assume that the tax rate is 50%. So tax is 7 lakh 50,000, here it is 5 lakh 50,000. 15 lakh into 50%, it will give you 7 lakh 50,000, here it is 5 lakh 50,000. And earnings after tax is 7 lakh 50 and 5 lakh 50,000, right? So this is your earnings after tax, and this earning after tax is available for distribution to equity shareholder. So this is the earnings of, there is no preference share here. So whatever is earnings after tax, that is your EAES, that is earnings available to equity shareholder. So this is the earning available to equity shareholder of firm A and firm B. And number of equity share in case of firm A, 100 lakh divided by 10, it comes to 10 lakh. Here 60 lakh divided by 10, it comes to 6 lakh, right? So earnings per share 7 lakh 50,000 divided by 10 lakh, because this is the earnings, and these earnings will be distributed among the total number of share to find out the EPS. So 7 lakh 50,000 divided by 10 lakh, it comes to your 0.75. Similarly, your 5 lakh 50,000 is the earnings and 6 lakh is the equity share. 60 lakh divided by 10, so number of equity share is 6 lakh, and 6 lakh if we divide, it comes to 0.917. So here what we see, in firm A is unlevered, there is no debt. There is no debt, but the earnings per share is 0.75. Here there is a debt, and in spite of debt, the earnings per share is 0.917, right? So earnings per share in case of firm B is quite high than earnings per share in case of A. What is the reason behind this? The reason is very simple. The firm borrowed capital for 40 lakhs. How much it pays the interest? It pays the interest 4 lakh. On this 40 lakh, it get a return on 15%. This is your return on investment. So by investing, by using this 40 lakhs, the firm gets 40 lakh into 15%, it gets 6 lakh. So this is your return on investment. This is your interest which the firm is paying to the debenture holder or to the bank. So here there is a net gain of 2 lakh. So what we are seeing here, the firm is using rupees 40 lakh and getting rupees 6 lakh as return. 40 lakh into 15%, it will give you your 6 lakh as return on investment. But out of 6 lakh, since the money has been borrowed at 10%, the company is paying 4 lakh as interest, as fixed charge. So, net gain of 2 lakh out of this 40 lakh of investment. This 2 lakh gain will automatically go to the earnings of shareholder and the EPS, earnings per share, increases. So this is your trading on equity. Suppose a company is earning return on investment is not 15%, it is less than 10%, the debt cost is 10%. Here in this particular example, your return on investment is greater than your rate of interest. Rate of interest. Return on investment is 15%. Rate of interest is 10%. Therefore, there is a gain of 5% and it increases the EPS. Suppose if we can take 10% is the rate of interest, but return on investment is say 6%. So if I have a return on investment 6%, that means the company is getting 6% and paying 10%. 40 lakhs ka upar, in 40 lakhs, it is getting 6%. So this thing will change. How much it will be coming? In case of return on investment is 6%, 2,40,000. That is your 40 lakhs into 6%. So 2,40,000 will be the return on 40 lakh. If I take the return on investment as 6%, that is less than 10%. So 2,40,000 I am getting out of investment of 40 lakhs. I invest 40 lakh, I get 2,40,000. But I have to pay 40 lakh into 10%, 4 lakhs. I will be paying 4 lakh to the bank, to the debenture holder, to the person who has given loan to me. This is a cost of debt, 4 lakh, but my on investment I am getting a return much less than that 4 lakh. So here 1,60,000 is the loss the company is suffering out of that. So in this case, the EPS will decrease. The EPS of firm B, that is your levered firm, will decrease, and firm A EPS will be higher. So if return on investment is greater than rate of interest, EPS will increase. If return on investment is less than rate of interest, EPS will decrease because this result in a loss. Right? So this concept is your trading on equity. The trading on equity is generally the use of fixed cost source. Fixed cost source is your debt preference share, because they have the fixed rate of return, and how it will help in earnings of the firm. This is in turn your degree of financial leverage, that is EBIT divided by EBT, earnings before tax. So trading on equity is sometimes called as earnings on, that is your degree of financial leverage. This is most important. Another one point which definitely we shall discuss: what are the advantage and disadvantage of trading on equity? The trading on equity, if the return on investment greater than rate of interest, if return on investment is greater than rate of interest, we can say EPS will increase, earnings per share will increase. If return on investment is less than rate of interest, EPS will decrease. So a firm with a good management skill, they can borrow funds and they can utilize the funds to increase the ROI so that EPS will increase. If earnings per share will increase, definitely the value of the firm will increase. Similarly, if we take ROI is less than rate of interest, that means it results in a loss. Suppose the ROI is 6%, 100 rupees investment, 6 rupees return. Rate of interest is 10%. That means if I invest 100 rupees, I will get from the business rupees 6. But I have to pay 10 rupees as interest. So in every 100 rupees, 4 rupees I have to suffer. I have to incur loss, and that will be the loss of EPS. Earnings per share will decrease. So these are the advantage depends on the efficiency of the management. If the management is efficient, if the business model is sound and giving good return, market is good, then it is better the company will take loan to increase the EPS. But what are the disadvantage? If you calculate the degree of financial leverage, in case of unlevered firm, जहां कोई डेप्ट नहीं है, then there is no debt. In that case, degree of financial leverage will be 1. EBIT and EBT is same. In case of a levered firm, where debt is there, the degree of financial leverage will be greater than 1. Let us take an example. Firm X, firm Y. EBIT, let us assume EBIT as 1 lakh. Here also 1 lakh. Less interest. No interest because it is a unlevered farm. Here interest is say 40,000. Right? So EBIT, here it is 1 lakh, here it is 60,000. Now if we calculate the degree of financial leverage, it is EBIT divided by EBT. So 1 lakh divided by 1 lakh, it will be 1. Here it is 1 lakh by 60,000. This will be 1.67. So what does it giving information? In case of unlevered farm X, where there is no debt, the risk, financial risk is only 1, that is no risk. But in case of farm Y, it is greater than 1.67. So here the farm carries financial risk more. So this is one disadvantage. Another disadvantage, suppose the farm is now earning very good and in the future year the farm's earning drops. The farm's earning become less than the cost of debt. So the company will have to suffer loss. EPS will decrease, market price will decrease. क्यों? Now in beginning, at the beginning, the rate of return on investment was high, rate of interest on debt was low, therefore EPS was good, everything was good. But in the future, the return on investment become less and lesser than the cost of the debt. You can take example. Return on investment is 6%. Cost of debt is 10%. So on 100 rupees, I am getting 6 rupees as return. But I am paying 10 rupees as debt interest. So 4 rupees will be my loss for every 100 rupees. Therefore, in that case, there is a possibility that the company will go bankrupt. The company's value will decrease. So these are the disadvantages. Another advantage is that in case of a levered farm, there is a tax on 40,000. This is the interest. And if interest is charged in the profit and loss statement, if interest is charged, profit will decrease and tax liability will decrease. So on 40,000 interest, if rate of tax is say 50%, rate of tax is 50%, so tax savings will be 40,000 into rate of tax 50%, tax savings will be 20,000. So in case of a levered farm, the farm can get the tax advantage. The tax liability will decrease. This is again an advantage of trading on equity. So friends, if you continue to see the trading on equity, if the management can ensure higher rate of return, then trading on equity is good. It will increase your value. If the company's earnings or return on investment is not good, it is suffering, then trading on equity is not suggested. So friends, I have explained you with the example trading on equity. You can, on writing the questions and answer, you can include that example which I had given to you, and the question answer what is trading on equity and how you will write the question answer. That has been, if you go through the complete video, you will see the question answer, questions with model answer has been given at the end. So if you like the video, please subscribe and offer your comments. If any doubt is still coming, then if you include your doubt in the comments, I will come out with the further explanation. Thank you. Thank you.